I'm not a financial advisor. This is not financial advice. Please do your own research. Welcome to the VinnyGMarkets channel, brought to you by Vinny G Money. First off, I hope everybody is enjoying or enjoyed their Labor Day weekend. I know I did. It was topped off by drafting 2 championship fantasy football teams, but I wanted to go over some market updates on where we left off last week. So where did we leave off? Let's go to September 1st. NASDAQ new record high. September 2nd, S&P 500 and NASDAQ record highs. And September 3rd on Friday, NASDAQ some more record highs. So we do see the stock market continue to go up, but let's go over some of the economic news that came out last week, which I'm sure you guessed isn't really good news. But let's get right into it. The first article we have are those first-time unemployment claim numbers. You'll see that it stated that those claims did reach a pandemic low, but it is still a total of 340,000 more people filing for first-time unemployment numbers. They'll try to say that this is good, that the estimation was 345,000, but these are just 340,000 more people filing for first-time unemployment claims. That number really isn't good at all, especially when we go into our next article. This is a monthly jobs report, some type of payroll growth report that they did for the month of August. You'll see that the expectation was 720,000 new positions to be added. The number came out to 235,000. That's such a miss. They can't even spin this as good. And it also makes you wonder what these economists are looking at and also what they actually get paid to do that they miss this number by such a wide mark. And our next article looks into the inflation going on in food prices. The article of this is Global Food Costs Jump Back Near Decade High on Harvest Woes. And you'll see this is reported by the United Nations. World food prices have rallied about 33% in the past year. That's crazy. And you could even take a look at this chart by Bloomberg on how high that this inflation is going for food prices. And you see in this article, they're blaming it on supply chain issues and worker shortages, not to say it's not happening. But what they're not going to tell you is this inflation is happening because of the Federal Reserve pumping their money. When you have more money chasing the same amount of goods, or actually a less amount of goods, it's just going to create inflation across the board at rates we've never seen before. And with all this going on, you'll see that at the start of this week, those extended unemployment benefits, that's ended. That extra $300 a week, that's no longer going to be into effect starting this week. Also, we see that those eviction moratoriums, those are ending. I think it's only a handful of states that are actually extending this program, and the extension, I believe, is by a few months. So with that extra money getting cut off and the eviction bans getting cut off as well, that's going to be the narrative for the Federal Reserve to not taper. And you're starting to see this a little bit on CNBC, where people are coming out and saying the worse the economy is, the better for the stock market it's going to be, for that point of the Federal Reserve not being able to scale back on their asset purchases. But if you have been following this channel, you'll see that this narrative was actually reported on this channel first. And we'll go over a narrative that could be put in place where the Federal Reserve actually can start tapering at the end of this year. We'll go over that later on in the video. But that's the point of this channel as well. I want to keep you ahead of the curve when it comes to the stock market. And also when it comes to the financial news, you're going to hear narratives on this channel before you're going to hear them on CNBC. You could keep me honest, listen to this channel, and you'll see that's going to be the case. And you should start seeing that if you have been watching the videos from the start on this channel. But let's now take a look at our indicators. We'll first pull up the 10-year Treasury yield. You'll see at the time of this video, it's at a 1.32%. It's still in that nice range that we're looking for. Again, when it comes to this 10-year Treasury, we're just not looking for it to spike higher. And that's when we're going to know that it's time to switch our views on the market. If we pull up the US dollar, you'll see that it's slightly higher now. But all from last week, it has been down. So what's the main thing that we look at to judge these two indicators? It's those Federal Reserve reverse repos. So if we go to the website, we'll see what they did this week. If we take a look, Friday, there's another 1 trillion. If we go to Thursday, we see there was another 1 trillion in reverse repos. Wednesday, another 1 trillion. Tuesday, a 1.1 trillion. I think we covered this in our last video. and Monday we were at another 1.1 trillion in reverse repos. So you see that number is still over $1 trillion each day by the Federal Reserve. So as long as those stay elevated, I wouldn't expect the 10-year Treasury yield to spike or the US dollar to have any significant gains. Again, the only other thing that will affect this is if the Federal Reserve comes out claiming that they're going to taper sooner than later. But those reports are usually fake unless it's being stated by Jerome Powell. It can't be taken seriously. And then even if anything's stated by Jerome Powell, we still have to take a look at these reverse repos to see if they're actually telling us the truth. So now we'll pull up our third indicator, which is crude oil. At the time of this video, it's at $68.75. So this is that last piece that we need to make the market go higher. You'll see that all last week it did move higher. It actually did go above $70 before it started pulling back. But also, same thing with the stock market. Once these things go higher and hit record highs, it usually does have a pullback. It can't go up every day. So when there are down days, we just have to expect that, and we'll just wait for it to go higher. I still see crude oil going much higher than that $70 range. One, because the stock market needs it to move higher. And two, the rising cost of energy prices and supply chain issues are the two scapegoats when it comes to inflation, because they don't want you to know that inflation is being caused by the amount of money they're printing. But we still need to monitor crude oil in the news. We'll pull up our first article, the results of that OPEC meeting we were talking about in our last video. The results were nothing's really changing. They, back in July, started adding 400,000 barrels per day, which is already baked into the price of crude oil. They're not increasing or decreasing that number. They're staying the same. So that news was good enough to push the price of crude oil over 70 last week before it started giving back a little bit. Before we go over the second article, my prayers are with everybody who got hit by Hurricane Ida. It was a disastrous hurricane. Again, my prayers are with all family and people that were affected by it. But that storm, it did hit the Gulf hard and the oil refineries in there. Supposedly, those oil refineries are going to be shut down for a little bit. So that will affect the price of crude oil, as it will affect the supply. So that's just something we're going to have to monitor going forward. And our last piece of oil news is that Minnesota oil pipeline that we went over in our last video. The courts did rule in favor of the company for that pipeline to put in those updates, which could increase production. But now certain members of Congress are calling upon President Joe Biden to put a stop to this update. Whether or not that's going to happen, who knows? But again, this is now something we still have to monitor to see if they're going to make those updates to the pipeline or not. But looking at all three of our indicators, 10-year Treasury stable, US dollar down, crude oil going above 70 before getting pulled back slightly, but up overall. I still would be long on this market. Those indicators are telling us that this bull run isn't over and the Federal Reserve isn't done pumping money into the market. But I did want to talk about the possible door being open for the Federal Reserve to taper. That jobs report that we got, where they were expecting 720,000 payroll increases but only got 235, that could be spun off as these are the worst numbers that we're actually going to see when it comes to jobs, at least for this year. So along with that terrible report and people now not getting that $300 extra bonus money, along with the holiday season coming along, people are going to need to go back to work. They're going to want to go back to work because they want to make extra money going into the holiday season. And also, there's just going to be even more jobs out there as the holiday season comes along. So we could start seeing better job report numbers. And as we start seeing better job report numbers towards the later of this year, that's when the Federal Reserve can start saying, you know what? Now we might be able to start tapering. So that's a narrative you might start see playing into the fourth quarter. Again, you know where you heard it first on the VinnyGMarkets channel, because that's my main purpose too. I want to give you the narratives before they start posting it on the mainstream media, which you're always going to get here on this channel first. Again, keep me honest on it. That's why you should tune in here, because that's the edge you're going to get. You're going to get the news, that narrative on this channel before you start hearing it on the mainstream media, which is going to enable you to make better investment decisions. And real quick, I wanted to pull up Microsoft. I know I was talking about paper trading, selling puts for Microsoft, that the price needed to stay above $300 by Friday. You see it did stay above $300. We did have to sweat it out a little bit, but it did stay above that 300 price where we would have been able to keep the premium that we collected once we sold that put. And when it comes to the crypto market, I do want to start making separate videos to give updates. I am pressed for time, believe it or not. I'm not a self-made investing millionaire. I have a 9-to-5 like most people. So I'm going to do a quick one at the end of these videos. But you see cryptos have been moving much higher. It is the first of the week, like we stated in the subconscious video. And also, it's a holiday week, so that weekend did get extended. So we had an extra day where the market was closed, where people flocked to the crypto market. You see Tether's been pumping nicely this week. Also, if you look at the 90-day outlook from Tether, you see since August 1st that Tether has been pretty much pumping. We could look at the grayscale purchases. If we look at the first part of this week, you see that they were at 43.4 billion. By the end of this week, they were at 46.8, so that's 3 billion in purchases by grayscale. So I'm thinking the prices should stay up or continue to move up, maybe pull back here and there. But any major pullback is going to be that week of the back contracts. So that's something we're going to monitor, or at least how I'm looking at the crypto market. And I wanted to end this update with this article. Everybody should read this article. I'm going to leave the link down below. But this goes into the fourth industrial revolution. I do need to make a separate video about that. But that's basically the takeover of robots, drones, algorithms, AI, taking human jobs, and just basically taking humanity out the picture. This is an AP article. You see a title, "Do We Need Humans for That Job? Automation Booms After C-Word." And we'll see. We'll pull up some interesting stats. Again, you should read this article in its entirety when you have any type of free time. But let's take a look at this. It says, employers seem eager to bring on the machines. A survey last year by nonprofit World Economic Forum found that 43% of companies plan to reduce their workforce as a result of new technology. Since the second quarter of 2020, business investment in equipment has grown 26%, more than twice as fast as the overall economy. This article also states, improvements in robot technology allow machines to do many tasks that previously required people: tossing pizza dough, transporting hospital lines, inspecting gauges, sorting goods. The pandemic accelerated their adoption. Robots, after all, can't get sick or spread disease, nor do they request time off to handle unexpected childcare emergencies. Economists at the IMF found that past pandemics have encouraged firms to invest in machines in ways that could boost productivity, but also kill low-skilled jobs. Our results suggest that the concerns about the rise of robots amid the COVID pandemic seem justified, wrote in a January paper. So you see that this is a narrative that's starting to be played, that people aren't going to be needed to work anymore, and that's why you see more universal basic income programs being pushed upon the people, because they know that's going to be the long-term answer. People already got used to staying home and not working, so nobody's going to fight this. Again, I do need to make another separate video when it comes to the fourth industrial revolution, but anytime I come across especially articles like this that kind of explain it, I'm going to put it out there so people just start getting used to the idea, because most people have no idea what's going on and what the plans are for the future. But that's all we got for today. I want to thank everybody for the listen. Again, if you like what you heard, Hulk smash that like button. And as always, I want to leave everybody off with this: the God of the Bible, the God of Abraham, the Father of our Lord and Savior Jesus Christ, is real, and may He bless you.
You've been listening to the Fed. You heard Jay Powell in his Jackson Hole Symposium speech. Are you concerned too?
I have been very concerned about the Fed policy, Kathleen, and the Friday speech that Chairman Powell gave to Jackson Hole made me even more frightened in terms of what was ahead. Essentially, given the fact that home prices are rising at a record rate, as you discussed a bit earlier, and you have rents are increasing, and inflation month to month on the CPI hits the numbers that we haven't seen in decades, the chairman continues to maintain that it is all transitory. So he I don't know where his evidence comes from, if there is any evidence at all. And the fact that the tapering, if it happens, will be at year end, means that you're going to have another several more months of $120 billion of bond purchase.
Okay.
Home prices are increasing, but he will.
So,
Sorry, go ahead.
well, thank you. So in terms of the bond market, Jay Powell, because he says, look, this big inflation spike is largely due to things that happened because of the pandemic. Used car prices got more expensive, etc. That's why he thinks it's going to be temporary. Is the bond market being too complacent? They seem very convinced by Powell's argument. Inflation's going to start coming back down, and we don't have to worry about an early taper or earlier rate hikes.
The bond market is complacent, Kathleen, and I think the bond market is banking on the fact that the Fed can step in and keep purchasing the bonds and push the yield down. So the question is, do you want to fight the Fed? And my answer to that question is, yes, you need to fight the Fed, because the Fed cannot win at all times. We have had times in history when the Fed goes to extremes, it doesn't anticipate what is going to happen, and then the whole thing fails. One example was the effort to keep interest rates, bond yields under control during the 1940s, early 50s, and it just collapsed. 2008, the Fed did not foresee the crisis. So Fed is not omnipotent, they are not omniscient, and that's the problem.
Shri, we just had